Welcome to the deep dive. Today we're zeroing in on IFRS 9 financial instruments, a set of rules that really shook up how companies account for their financial assets and liabilities.
Yeah, definitely a big change.
Think of it as moving from an old, maybe slightly blurry snapshot to a much clearer, high-definition picture compared to its predecessor, IAS 39. We're going to extract the vital information about these changes without getting bogged down in, overly technical details.
Exactly. You, our listener, have given us some fantastic in-depth sources on IFRS 9, everything from the official pronouncements to how to actually apply it, and even some practical examples.
Mm-hmm.
So our mission in this deep dive is to pull out the most important insights from all that material, focusing on the three core areas where IFRS 9 brought about the biggest shifts.
Right. We're going to take a close look at how financial instruments are classified and measured now, then explore the new way of thinking about potential losses with expected credit losses, and finally, demystify the updates to hedge accounting.
Sounds good.
Our aim is that by the end of this, you'll have a solid grasp of what changed and, crucially, why it matters in the real world.
So let's begin by looking at the overall landscape. Our sources confirm that while the fundamental scope, what kinds of financial instruments IFRS 9 applies to, and the rules for when you initially record or remove them from the books, well, those are largely the same as they were under IAS 39.
Okay.
But the standard introduced three really significant changes.
Okay, let's unpack this. Those three pivotal areas, as we've mentioned, are classification and measurement,
Yep.
impairment, and hedge accounting. These are the three cornerstones of IFRS 9 that we need to understand to see how it represents a real departure from what came before.
Precisely. Let's dive into the classification and measurement of financial assets first. Now, under the old IAS 39, there were several different ways you could categorize these assets. Quite a few boxes.
Right, it felt a bit complex sometimes.
Could be. IFRS 9 simplified this significantly with a single, more unified approach that applies to all types of financial assets.
So instead of having to decide which of many different boxes an asset fits into, there's now a more consistent framework. And one of the key ideas here is basic lending instruments. What exactly makes a financial instrument basic in this context, and why is that important for how it's accounted for?
What's fascinating here is that if a financial asset is deemed to be a basic lending instrument, it becomes a candidate for measurement at what's called amortized cost.
Amortized cost.
Think of this as a more straightforward, cost-based way of accounting for it over time. On the other hand, the general principle under IFRS 9 is that pretty much all other financial assets are measured at fair value, which aims to reflect their current market price.
Got it. So a key determinant is whether the asset is essentially a plain vanilla loan. Now, the way a company manages these assets, their business model, also plays a really critical role. We've seen terms like hold to collect and sell. Could you explain what these models are and how they dictate the measurement approach?
Absolutely. If a company's business model is hold to collect, their main intention is simply to receive the contractual cash flows, those principal and interest payments, over the life of the financial instruments.
Okay, straightforward enough.
In this scenario, amortized cost is often the appropriate way to measure these assets. However, if the business model is hold to collect and sell, the company manages these assets with a dual purpose, both to collect those contractual cash flows and with the option to sell them if needed, maybe for liquidity or risk management.
Okay, so it's like having two potential exit strategies in mind. How does that dual objective translate into the accounting?
Here's where it gets really interesting. In the hold to collect and sell model, while the company intends to both collect and potentially sell, the financial assets are actually reported at fair value on the statement of financial position, the balance sheet.
Ah, okay, fair value on the balance sheet. But what about the income statement?
Well, the impact on profit or loss of the income statement is designed to look quite similar to what it would have been if the assets were measured at amortized cost, including recognizing any impairment losses.
Right.
The difference between the fair value and the amortized cost is then presented in other comprehensive income, or OCI.
OCI.
And think of OCI as a separate section of equity where certain gains and losses bypass the income statement, at least temporarily.
That's a really nuanced point. So you see the market value on the balance sheet, but the day-to-day impact on the profit number is more aligned with a cost-based method with those fair value adjustments going through OCI. What about financial assets that don't quite fit into these hold-to-collect models or aren't considered those basic lending instruments we talked about earlier?
Good question. If a financial asset doesn't meet the criteria to be classified as a basic lending instrument, or if it isn't held within a hold to collect or hold to collect and sell business model, then it generally falls into the category of being measured at fair value through profit or loss, or FVTPL.
FVTPL.
All right. This means that any changes in its fair value directly hit the profit or loss in each reporting period. So these are assets where market fluctuations immediately impact the bottom line.
That seems fairly direct. Now, you mentioned the basic lending criteria, and a key part of that is the contractual cash flow characteristics test, specifically the SPPI criterion. What does SPPI stand for, and how does a company determine if a financial asset passes this test?
SPPI is an acronym for solely payments of principal and interest.
Okay, SPPI, solely payments of principal and interest.
Exactly. The contractual cash flow characteristics test essentially assesses whether the contractual terms of a financial asset will result in cash flows on specific dates that are purely payments of the principal amount outstanding and interest on that principal.
Right.
The principal here is the fair value of the asset when it was first recognized, and interest is basically the compensation for the time value of money, the credit risk associated with an outstanding principal during a particular period, as well as other fundamental lending risks and costs.
So it really boils down to the fundamental nature of the cash flows. Are they just about repaying the loan and the cost of borrowing? But the sources also point out that some contractual features that might change the timing or amount of those cash flows can still satisfy the SPPI criterion. How does that work?
Yeah, this is an important point that adds a bit of flexibility to the SPPI test.
Mm.
Certain contractual provisions that could alter the timing or amount of cash flows can still be SPPI consistent if they're fundamentally linked to a basic lending arrangement.
For example?
For instance, if a borrower misses a payment, the contract might specify a higher interest rate as a way to compensate the lender for the increased credit risk. That makes sense in a lending context.
Mm-hmm.
Similarly, reasonable prepayment penalties are usually acceptable because they compensate the lender for the early termination of the loan. The key is that these kinds of changes should be directly related to the core lending relationship, not introducing some sort of equity risk or volatility unrelated to basic lending.
That makes sense. It's about making sure the essential nature of the instrument remains a lending agreement, despite these potential adjustments for things like late payments or early repayment. Now, let's switch gears and talk about equity investments. How are they treated under IFRS 9?
Generally, IFRS 9 mandates that all investments in equity instruments are measured at fair value. Full stop.
Okay, fair value for equities.
However, there's a significant exception here. When an entity initially recognizes an equity investment that isn't held for trading purposes and isn't contingent consideration in a business acquisition, it can make an irrevocable election.
Irrevocable.
Yes, irrevocable. A one-time choice at the start. It can elect to present any subsequent changes in fair value in other comprehensive income OCI. This choice is made on an investment-by-investment basis.
So for those longer-term equity stakes that aren't actively traded, companies can choose to keep the ups and downs in their market value out of their immediate profit or loss. But the sources also touch on some complexities with investments in funds that might expose investors to equity-like risks, but have features like being puttable and don't quite meet the strict definition of an equity instrument. What's the challenge there?
Right. This is a tricky area. What's particularly interesting here is that for these types of puttable instruments, that option to run fair value changes through OCI isn't available.
Ah, okay. No OCI option.
Exactly. Furthermore, because they often don't pass that contractual cash flow test we discussed, they might lack those pure principal and interest characteristics. They end up having to be measured at fair value through profit or loss, FVTPL.
I see.
And this measurement might not always align with how these assets are managed, perhaps in a long-term investment strategy, potentially making the accounting information feel less relevant for understanding the underlying business model. It's a consequence of the strict criteria.
That really highlights a situation where the principles-based approach of IFRS 9 can lead to accounting outcomes that might not perfectly reflect the economic intentions behind holding certain instruments.
What about derivatives? Where do they fit into this classification and measurement picture?
Derivatives, well, by their very nature, they don't typically have contractual cash flows that are solely payments of principal and interest in a way that would make amortized cost a suitable measurement.
Right, their value comes from something else.
Precisely. Their value is derived from an underlying variable, and their future cash flows can be quite uncertain, volatile even. Because of this, derivatives are generally measured at fair value through profit or loss.
Okay.
The same logic often applies to debt instruments that fail the SPPI test. Fair value is seen as a more relevant indicator of their future economic benefits and risks compared to amortized cost.
Okay, that gives us a good handle on how things are initially classified and measured. Now, what happens if the way a company manages its financial assets changes? Are they allowed to reclassify them under IFRS 9? Yes, reclassifications between measurement categories are permitted under IFRS 9, but, and this is a big but our sources really emphasize that these are only required when there's a genuine change in the entity's business model for managing those specific financial assets.
Okay, so it's not optional, it's required if the model changes.
Exactly. And importantly, these changes are expected to be infrequent and must be significant to the entity's overall operations and demonstrable to outside parties. You can't just decide to change it.
So this isn't something that can be done on a whim or, say, in response to short-term market movements. What kind of events would be significant enough to trigger a reclassification?
A change in business model would typically involve the entity starting or stopping a significant business activity,
Yeah.
like acquiring, disposing of, or terminating a major business line, something really fundamental. The standard specifically says that temporary market disruptions or, just changes in intention about a particular asset due to market conditions are not enough to warrant a reclassification if there's no fundamental change in how the business manages those assets overall.
That makes sense.
And importantly, IFRS 7 requires companies to provide detailed disclosures about any such reclassifications they make. So there's transparency.
That makes sense. It prevents companies from strategically switching accounting methods just to smooth out their financial results due to temporary market ups and downs. Okay, let's move on to the second major area of change under IFRS 9 impairment. The old incurred loss model under IAS 39 has been replaced by a forward-looking expected credit loss model. This sounds like a pretty big shift in mindset.
It's a very significant change, huge, really. Under IAS 39, you only recognized a credit loss when there was objective evidence that a loss had actually been incurred, like a default or a significant financial difficulty of the borrower.
So you waited for the bad thing to happen.
Pretty much. The IFRS 9 model, however, requires companies to think ahead and consider potential future credit losses right from the moment a financial instrument is recognized, even on day one. This naturally leads to an earlier recognition of credit losses.
So it's a much more proactive approach, trying to anticipate problems rather than just reacting to them. Could you walk us through the 3 stages of impairment under this expected credit loss or ECL model?
Certainly. The IFRS 9 impairment model is structured around 3 stages: Stage 1, Stage 2, and Stage 3.
Okay, stage 1.
In Stage 1, which applies to financial instruments where the credit risk hasn't increased significantly since they were initially recognized, companies recognize what are called 12-month expected credit losses.
12-month ECL.
Yes. These are the credit losses that are expected to result from potential default events within the next 12 months after the reporting date.
And what would cause a financial instrument to move from stage 1 to stage 2?
A financial instrument transitions to Stage 2 if, at the reporting date, the credit risk associated with it has increased significantly since it was originally recognized. It's about the change in risk.
Okay, a significant increase.
Right. In this stage, the entity recognizes full lifetime expected credit losses, which are the credit losses expected over the entire remaining life of the instrument, not just the next 12 months.
Lifetime ECL. Got it.
Now, there's a practical shortcut or expedient. Companies can assume that credit risk hasn't significantly increased if the financial instrument is still considered to have low credit risk at the reporting date, regardless of the change since origination.
Ah, okay. Bit of relief there for low-risk stuff. And finally, stage 3. What characterizes a financial asset in this stage?
A financial asset enters Stage 3 when it is considered to be credit impaired. Essentially, there's objective evidence of impairment, similar in concept to the old IAS 39 trigger, but applied within this new framework.
Okay, so it's actually impaired now.
Yes. At this point, the company continues to recognize lifetime expected credit losses. However, a key difference in Stage 3 is how interest revenue is calculated.
Oh, how does that change?
For assets in this stage, interest revenue is calculated by applying the effective interest rate to the amortized cost of the asset, which is the original gross carrying amount minus the accumulated impairment allowance.
Right, netting off the loss allowance first.
Exactly. If the asset was actually credit impaired right from the start when it was purchased or originated, a credit-adjusted effective interest rate might be used instead.
So once an asset is deemed credit impaired, not only do you recognize the full expected loss, but the way you account for its income changes too. Now, we keep hearing the term expected credit losses. How are these losses actually defined, and how do companies go about measuring them?
Good question. Expected credit losses are defined as a probability-weighted estimate of credit losses over the relevant time horizon, either 12 months or lifetime.
Probability weighted.
Yeah. And a credit loss itself is the present value of all the cash shortfalls. That's the difference between the cash flows that are contractually due to the company and the cash flows that the company actually expects to receive, discounted back.
Okay.
That probability-weighted estimate takes into account not just the likelihood of a loss occurring, but also different possible scenarios, and importantly, the time value of money. So future losses are discounted back to their present value using the original effective interest rate.
That makes sense. It's not just about the total amount of potential bad debt, but also the likelihood of it happening and when it might occur, and the time value. The sources also mention a simplified approach for certain types of receivables. Could you elaborate on that?
Yes, there's a simplified approach specifically for trade receivables, contract assets that don't have significant financing component under IFRS 15, and also lease receivables under IFRS 16.
Okay, what's simplified?
For these types of assets, a company always recognizes a loss allowance equal to the full lifetime expected credit losses. There's no need to track significant increases in credit risk or distinguish between stage 1 and stage 2.
Ah, so you skip the 12-month versus lifetime assessment for those.
Exactly. This simplification is mainly because these assets typically have shorter lifespans, meaning the 12-month and lifetime expected losses would often be very similar anyway. Plus, for things like short-term trade receivables, interest isn't usually charged explicitly to compensate for credit risk. It just makes things more practical.
So for these shorter term items, the expectation of potential losses over their entire life is factored in right from the beginning. Now, when it comes to assessing whether credit risk has significantly increased since initial recognition, which is the trigger for moving from stage 1 to stage 2, what kind of factors do companies consider?
The assessment of a significant increase in credit risk really focuses on the change in the probability of a borrower defaulting the PD over the expected life of the instrument, comparing the risk at the reporting date to the risk at initial recognition.
Change in probability of default.
Yes. This aligns with how credit risk is generally monitored and managed in risk management practices. Companies will look at all reasonable and supportable information that's available without undue cost or effort, and that could affect credit risk.
Such as?
Well, this can include things like changes in external market indicators, internal metrics like payment status or behavior scores, significant changes in the borrower's operating results or financial condition, changes in credit ratings, or even qualitative factors indicating a deterioration in the borrower's financial health or the economic environment they operate in. It's quite comprehensive.
And how is default actually defined under IFRS 9? Is there a specific universal threshold?
Interestingly, IFRS 9 doesn't provide a precise, one-size-fits-all definition of default. It recognizes that default can mean different things in different contexts.
Right.
So instead, it requires each company to establish its own definition that is consistent with how it defines default for its own internal credit risk management purposes for the specific financial instrument in question.
That allows for flexibility.
It does. However, the standard does include a sort of guideline or rebuttable presumption. It says there's a presumption that default doesn't occur later than 90 days past due, unless the company has reasonable and supportable information to demonstrate that a more delayed definition of default is more appropriate for that specific instrument.
Okay, so 90-day backstop unless proven otherwise.
Pretty much. Whatever definition is chosen needs to be applied consistently to all instruments with similar risk characteristics.
That makes sense, allowing for some flexibility based on different industries and circumstances while still providing a general benchmark. What happens with the impairment assessment if a financial asset's terms are modified, like in a restructuring?
That's a common scenario. If modifying a financial asset results in it being derecognized, essentially,
Yeah.
the old loan is extinguished and it's treated as a brand new loan, then that new asset's initial recognition triggers a fresh impairment assessment under the ECL rules. You start again.
Okay, makes sense for a new loan. What if it's not derecognized, just modified?
If the modification doesn't lead to derecognition, the modified asset isn't automatically considered to be lower risk just because its cash flows have been changed, maybe to make them easier for the borrower to meet.
Right.
You would need evidence of improved creditworthiness, like a consistent history of timely payments under the new terms, to potentially move it back from, say, stage 2 or 3 to a lower impairment stage. Just 1 or 2 on-time payments after a history of missed ones wouldn't typically be enough to indicate a sustained improvement in credit risk. You need to see a track record.
So the past payment history still carries weight even after a modification.
Right.
We've talked about the forward-looking nature of the ECL model and how it considers probabilities of default. Does this also involve taking into account broader macroeconomic conditions?
Absolutely. This is a key part of the forward-looking requirement. The ECL model explicitly requires consideration of reasonable and supportable forward-looking macroeconomic information.
Such as?
Things like forecasts of GDP growth, unemployment rates, interest rates, property prices, industry-specific forecasts, basically anything relevant that could reasonably influence the likelihood of borrowers being able to repay their debts in the future.
So it connects the accounting more directly to the economic outlook.
Exactly. This makes the ECL model much more sensitive to changes in the economic environment compared to the old incurred loss model, which was largely based on past events.
Lastly, in the impairment area, the sources mention purchased or originated credit-impaired financial assets, or POCI assets. How are these treated differently under the ECL model?
Right, POCI assets. These are financial assets that are already considered credit impaired when they are either purchased from a third party or originated by the entity itself, perhaps at a deep discount reflecting the impairment.
Okay.
For these assets, the accounting treatment is a bit different. The company only recognizes the cumulative changes in the lifetime expected credit losses since that initial recognition as a loss allowance.
Only the changes after you bought it.
Correct. Essentially, the initial purchase price or fair value at origination already reflects the market's or the entity's expectation of credit losses at that point. So subsequently, any favorable or unfavorable changes in those lifetime expected credit losses compared to the initial expectation are recognized in profit or loss as impairment gains or losses. This prevents recognizing losses twice, once implicitly in the purchase price and then again explicitly through the ECL model.
Ah, okay, that avoids double counting. That
Yeah.
gives us a really comprehensive picture of the significant changes in how impairment is approached under IFRS 9. Let's now move on to our third key area, hedge accounting. Our sources suggest that IFRS 9 aim to make hedge accounting more aligned with how companies actually manage their financial risks. How did it achieve this?
One of the main ways IFRS 9 accomplished this was by broadening the scope of what can be used as a hedging instrument and what can be designated as a hedged item. It also made the assessment of hedge effectiveness more principles-based rather than relying solely on strict quantitative rules.
More flexible, maybe.
You could say that. For example, under IS 39, if a derivative was embedded in a financial asset, and you had to separate it out for accounting purposes, that separated derivative generally couldn't be used as a hedging instrument itself.
Right.
But under IFRS 9's classification rules, the combined instrument, host plus embedded derivative, is often measured at fair value through profit or loss anyway. And in that case, the entire combined instrument can potentially be designated as a hedging instrument.
That sounds like a more integrated and practical approach, reflecting the whole instrument. What other notable changes were introduced when it comes to hedging instruments?
There are specific new requirements and options for using options as hedging instruments. IFRS 9 now allows companies to separate the intrinsic value and the time value of an option, and they can elect to defer changes in the time value of an option to other comprehensive income, OCI. Then, depending on what's being hedged, whether it's related to a specific transaction or something related to a time period, this deferred time value is later reclassified from OCI to profit or loss, often matching when the hedged item affects profit or loss.
Ah, aligning the timing better.
Exactly. This change aims to better reflect the economics of hedging strategies that utilize options, where the time value is often seen as a cost of hedging.
That's interesting. So the time value, which can be a significant part of an option's price, gets a different accounting path. What are the fundamental requirements for a hedging relationship under IFRS 9? What kinds of things can be hedged and what can be used to hedge them?
Okay, the basics. For a hedging relationship to qualify for hedge accounting under IFRS 9, you need eligible hedging instruments and eligible hedged items.
Right.
Typically, hedging instruments are derivatives, measured at FVTPL. Although in certain situations like hedging foreign currency risk, non-derivative financial assets or liabilities measured at FVTPL can also be used.
And the hedged items.
Hedged items can be recognized assets or liabilities, unrecognized firm commitments, highly probable forecast transactions, or even net investments in foreign operations. You can hedge single items, groups of items, or even components of items as long as they can be reliably measured and the risk component is separately identifiable.
More flexibility there too, it sounds like.
Yes, for a forecast transaction to be a hedged item, it still needs to be highly probable. And crucially, at the very beginning of the hedged relationship, it has to be formally designated and thoroughly documented. This documentation is key. It includes the company's risk management objective, their strategy for undertaking the hedge, how effectiveness will be assessed, etc.
We've heard about the removal of that quite specific 80, 125% quantitative effectiveness threshold from IS 39.
Yeah.
How has the assessment of whether a hedge is effective changed under IFRS 9?
Right, that 80, 125% bright line test is gone. It was often criticized for being arbitrary and not always reflecting the economics.
Yeah, it could lead to discontinuing hedges that were economically sound.
Exactly. The IFRS 9 effectiveness requirements are more qualitative and focused on the economic relationship between the hedged item and the hedging instrument. There are three main criteria.
Okay, what are they?
First, there must be an economic relationship between the hedged item and the hedging instrument, meaning you expect their values to move in opposite directions because of the hedged risk. Second, the effective credit risk shouldn't dominate the value changes that result from that economic relationship. And third, the hedge ratio used for accounting purposes must be the same as the one the entity actually uses for its risk management purposes.
So it's more about the underlying economics and the entity's actual risk management.
Precisely. While there's no strict numerical range anymore, the relationship still needs to be effective in achieving offset. But the removal of that rigid test means that even if a hedge isn't perfectly 100% effective, you might not have to immediately stop using hedge accounting. Instead, any ineffectiveness, the bit that doesn't offset, is recognized directly in profit or loss.
That sounds like a more pragmatic approach, aligning the accounting more closely with the realities of risk management. Are there any other new flexibilities introduced in hedge accounting under IFRS 9?
Yes, another significant one is rebalancing. IFRS 9 allows for hedging relationships to be rebalanced if the company's risk management objective for that particular hedge remains the same, but the quantities needed to maintain the hedge ratio change.
So you can adjust the hedge.
Yes, rebalancing involves adjusting the amounts or quantities of the hedging instrument or the hedged item to keep the hedge ratio aligned with the entity's risk management strategy, without having to de-designate and redesignate the whole hedge. Hedge accounting is only discontinued when the fundamental qualifying criteria are no longer met, or if the company's risk management objective itself changes.
And what about specific details like forward points in forward contracts that are used for hedging? How are they accounted for under IFRS 9?
Right. Forward contracts often have two components, the spot element and the forward points, which reflect interest rate differentials. IFRS 9 gives companies an accounting policy choice for the forward point component when hedging.
The choice?
Yes. They can choose to treat the forward points like the time value of options, initially recognize the changes in OCI, and then amortize them or move them to profit or loss over the life of the hedge, depending on the nature of the hedged item. Alternatively, they can include the forward points in the overall assessment of hedge effectiveness and recognize changes in their value in profit or loss immediately, along with any other hedge ineffectiveness. The approach chosen should really reflect the economic substance of the company's hedging strategy.
Finally, within hedge accounting, the sources mention some temporary exceptions related to the reform of interest rate benchmarks, like the move away from LIBOR or IBORs generally. Could you briefly explain those?
Yes, the IBOR reform. Given the massive ongoing global shift away from certain key interest rate benchmarks like LIBOR, IFRS 9 includes some mandatory reliefs and temporary exceptions.
To ease the transition.
Exactly. These provisions essentially allow companies to make certain assumptions when applying hedge accounting requirements during the reform period. For example, they might assume that the interest rate benchmark underlying their hedged item or hedging instrument isn't altered by the reform for the purpose of evaluating hedge effectiveness under certain conditions.
Okay.
They also permit amendments to the formal hedge documentation to reflect the necessary changes in the benchmark rate, like switching from LIBOR to a new risk-free rate, without automatically causing a discontinuation of hedge accounting, provided the change is economically necessary due to the reform. These temporary rules are designed to prevent widespread disruption to hedge accounting solely because of this market-wide transition.
That's a really helpful overview of the key updates in hedge accounting. Now, let's talk about the actual switch to IFRS 9. When did it become effective, and were there any options for adopting it early or any specific issues that were addressed during that transition period?
Sure. The general effective date for IFRS 9 was for annual reporting periods starting on or after January 1st, 2018. And yes, early adoption was permitted before that date.
Okay, 2018 generally.
Right. The ISB also issued some amendments specifically to address concerns that arose because IFRS 9 became effective before IFRS 17. the new complex standard for insurance contracts.
Oh, the timing mismatch.
Yes, because insurance companies often hold a lot of financial instruments to back their insurance liabilities. Having different effective dates could cause significant accounting mismatches and volatility. So these amendments allowed qualifying insurance companies to either defer the adoption of IFRS 9 until IFRS 17 became effective, or to apply what's called an overlay approach for a temporary period.
An overlay.
Yeah, the overlay approach basically lets them reclassify some of the profit or loss impact of designated financial assets from the income statement to OCI, kind of mimicking the effect of the older IAS 39 standard for those assets to reduce the volatility until IFRS 17 was in place.
Interesting workaround. And what were some of the main requirements or things companies had to consider during the transition to IFRS 9 itself, besides those insurance specifics?
Well, IFRS 9 generally required retrospective application for classification and measurement and impairment, with some exceptions. This means companies had to go back and restate their previous financial statements, particularly the opening balance sheet of the year they adopted it, as if they had always used IFRS 9.
Restatement can be complex.
It can be. The standard required companies to provide additional disclosures during the transition period, as outlined in IFRS 7 and IAS 8, to increase transparency about the impact, particularly around impaired assets and the changes in their accounting policies.
Any relief on that retrospective application?
Yes, there was specific relief and guidance for situations where full retrospective application, for example, retrospectively assessing whether a prepayment feature was insignificant under the SPPI test, or applying the complex effective interest method calculations retrospectively, was just not practical or would require undue cost or effort. In those cases, certain practical expedients were available to simplify the process.
Lastly, the sources briefly touch on how IFRS 9 might apply to the public sector. Are there any unique aspects or interpretations for government entities?
The application guidance does explicitly consider the public sector context. One notable point is the assessment of own credit risk for liabilities. It specifies that governments, exchequer funds, and the Bank of England, when they hold their own liabilities, are considered to have zero own credit risk.
Okay, that makes sense.
Also, when it comes to assessing the business model for managing financial assets in the public sector, the guidance suggests that a reevaluation is really only likely after a significant, publicly announced change in government policy that clearly demonstrates an impact on how those financial assets are managed. It acknowledges that public sector business models might be driven by different factors than purely commercial ones.
Right.
But overall, the core principles of IFRS 9 classification, based on cash flows and business model, the ECL impairment approach, the hedge accounting rules are generally applicable to the public sector without needing major modifications. The principles translate reasonably well.
So, while the fundamental rules apply across the board, the specific context of public sector entities and the types of financial instruments they typically hold are taken into account. Well, it brings us towards the end of our deep dive into IFRS 9. It's really clear that this standard introduced some fundamental shifts in how financial instruments are accounted for across classification and measurement, impairment, and hedge accounting, with a strong emphasis on looking forward and being more sensitive to risk.
Absolutely. By understanding these key principles, the business model and SPPI tests, the 3 stages of ECL, the closer link between hedge accounting and risk management, you, our listener, should now have a much clearer perspective on how financial reporting reflects the underlying economic realities of a company's financial instruments.
Yeah.
The move from looking backwards at incurred losses to anticipating expected credit losses, for instance. It offers a more timely and potentially more relevant view of credit risk and how it's being managed.
And on that note, here's a final thought for you to consider. Given this increased focus on expected credit losses and fair value accounting, and considering it applies across various industries, not just banks and financial institutions, how might this influence investment decisions and the overall risk management strategies of different types of companies? Think about the broader implications of these accounting rules on how we understand financial health and stability in the economy. Does it make things more transparent? Does it introduce new volatility? What are the knock-on effects?
That's a great point to ponder, indeed. The core concepts we've explored today really provide a solid foundation for understanding these important accounting changes. We encourage you to explore any specific aspects of IFRS 9 that are particularly relevant to your own interests or professional needs in more detail.
Thank you for joining us on this deep dive.